Ticker symbol VEEV is up around 6% for the past year, and today we'll be looking at a medium cap which offers a very unique solution. It is a highly predictable business which has solid fundamentals, rising efficiency ratios, and this company in particular has high recurring revenue and sustainable growth. So today we'll be looking at Veeva Systems, a product management company. In their annual report, they say that they're a leading provider of industry cloud solutions for the global life sciences industry. Now, this doesn't mean that they only work with the life sciences industry, it just means that they're focused on it, because recently they have been managing some sort of expansion and entry into different industries. What they have is a cloud-based software which helps companies bring, in this case, new medicines and new devices to market a lot faster, ensuring they follow regulatory rules. The reason why they have been expanding is because this doesn't only apply to medicines, it can also apply to the food industry, to getting patents, and for any type of product development. Their value actually comes from the fact that they help eliminate outdated and manual methods that make it a lot harder to manage documents and data. In this case, since everything's stored in their software, it is a lot easier to organize, access, and keep all their documents in check, especially during regulatory submissions, which for the pharma industry, it happens way too often. Now, Veeva is a very large company. It operates in across 80 countries globally, with continued growth in both existing and new markets. Because we have been living in a low interest rate, high growth period for a very long time, this company has been benefiting from the fact that a lot of companies have been introducing a lot of different products in all different industries. Especially due to COVID, the pharma industry has gotten a lot more attention recently. One great fact from Veeva Systems is that no single customer actually contributes more than 10% of total revenue, meaning that their risk is very well spread out. In many cases that we have seen in the past, companies tend to have one or two clients which make up between 15 to 20% of the revenues, meaning that if they lose one of those big clients, they will suffer in the short term. Finally, Veeva is not the only player in this industry. There are a lot of major companies such as IQVIA or Oracle, which also compete against them because they offer some cloud software solutions, which one of their functions could actually relate to product management. However, in the case of Veeva Systems, they have a return on capital employed of 15%, which is just in line with our threshold. They have an interest coverage ratio of above 100 times, meaning that they won't have to worry about debt in the short term, and they have a very solid cash conversion of 96%, which means that they're extremely efficient at generating free cash flows. Now, they have an extremely solid profit margin of 73%, and they have an operating margin of 24%, which is way above our threshold of 15% for this ratio. So far, it looks great. When we look at their growth trajectory, their revenue, gross profit, and net income has been growing every single quarter. Yes, their net margin did suffer a little bit entering 2024, however, nothing too scary since their net margin is still around 24%, which is very positive. As we can see, their operating income has increased by almost 50% year over year. And just what we can expect, their efficiency ratios have actually been improving. The one that has been a bit shaky is the return on invested capital. However, since January 2024, it has been on the rise again, and it is above 20%, which is a very solid place for it to be in. And when we look at their leverage analysis, it looks wonderful, since they're expanding their total assets at a way faster rate than their total liabilities, which is increasing their current ratio, and it is currently at the point where they have over 4 times their liabilities in assets, meaning that this company has a very safe financial position. And when we look at their fundamental analysis, this company gets an extremely solid 7 out of 8 ticks, because first of all, they have very low liability risk, as we have seen with their over 100 times interest coverage ratio. They have a very solid balance sheet, meaning that they can pay all of their short-term liabilities only by using their current assets. And the one thing that's special from this company is that they're extremely consistent at their cash flow generation, which is being allowed because of their free cash flow growth being organic, which at the same time is being driven by their revenue growth being organic. And by organic, you will know that I refer to them not needing to depend on M&A in order to grow their top line. Now, this company has a strong pricing power and a very wide existing moat or competitive advantage. The reason why this company has very strong pricing power is because their service actually improves the way of life of a company. In the pharma industry, it is extremely important to keep all your patents and all your regulatory filings in check. Veeva Systems actually has a very strong value proposition where it targets these type of companies, and it actually facilitates a lot of this management in order for them to keep doing what they do best, which is to innovate rather than organize documents. Additionally, Veeva Systems has been working with a lot of these customers for a very long time. And what this has caused is for a lot of these companies to become sort of dependent on Veeva Systems. Why? Well, because there would now be very high switching costs if they decided to go with one of their competitors, because they have a lot of expertise and knowledge on knowing how to use Veeva's platform, and they have all of their information managed inside this software. If they decided to go to Oracle, for example, one of the competitors' softwares, what they would have to do is retrain all their staff in order to know how to properly use the new software, and then of course migrate all the information of the company into Oracle. This would not only be very costly, but it would also take a lot of time. This is why they will prefer to stick around with Veeva, even if they're increasing their prices above inflation every single year. And now when looking at their competitive advantage, this relates to the fact that they have very long-standing relations with a lot of different clients, where usually in business, where you've had such a very long contract with a company, unless you're extremely dissatisfied or you find a competitor which is doing things a lot better than your current provider, you will tend to actually stick with them as a sort of loyalty. However, there is one point that I didn't quite like, and it is the fact that they don't pay dividends and the fact that their shares outstanding have not been decreasing, but in fact I believe they were increasing at a small rate. I understand that a company in its growth stage does not pay dividends. However, what I do not like to see is the shares outstanding growing. I do like to see companies actually exercise some sort of share buybacks every once in a while, especially when their stocks seem undervalued. Now, when we look at their valuation analysis, we can see that this company is currently trading at the lower threshold of its 4-year PE ratio. And when we look at their 2.94% free cash flow yield, this actually suggests that they're around fair value since the long-term inflation rate is around 3%. Now I see two main risks and possible challenges. The first one is regulatory risk, where possible upcoming regulation changes are a big factor for any company in the pharma industry. The main factor why this company was expanding into other solutions was to reduce this factor. And the thing with this risk is that you never know what will happen, but you always have to keep this risk in the back of your mind. And then the market risk, where I believe that this is actually a very cyclical industry, because companies do tend to produce and develop new products, because companies do actually tend to release and develop new products when spending is strong. And in case there is an economic downturn or people just start spending a lot less, investment in new products will actually reduce. However, one thing that Veeva has going for it is that since majority of their customers are actually in the pharma industry, this is less cyclical than other industries, since people will have to pay for medication even if there is an economic downturn. Now, before we move on, please remember I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I do believe that this company has a very strong competitive advantage. They're producing predictable and consistent cash flows with a high return on capital employed, meaning that it can create value for the investor. So I believe that this is a good company and it will probably be a good investment, but it does carry some cyclicality and regulatory risk. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.